Welcome to the Traders Clinic, your regular shot in the arm of trader insights, philosophy and knowledge, brought to you by two professional money managers, Ali Crooks and Charlie Burton.
In every show, we answer your burning trading questions and cover all things from the world of trading. So we're back.
We are.
And we're starting with an interesting topic, turning a small account into a big account.
Yeah, it's one of the big questions,
Yes.
That's why so many traders who get into it. We see a huge amount of traders who are underfunded or don't have the capital or have a low amount of capital. And this is why we see, all sorts of traders trying to go down the funded account route. But, really that's not our favored way. We are other people trading their own money at their brokerage. But how do you go from a small account to a larger account? And there's lots of things around this because are you going to have a target? Is there a target account size that you're trying to work towards? And so we need to discuss. Yeah, that can create its own issues when you hit certain milestones. Position sizing can be problematic potentially as well. As far as positions grow, then are you ready for it? You might be comfortable trading at, one lot, but are you comfortable trading at 2 or 3 lots? And so all of that sort of stuff going on as well. So there's that psychological side of things, and everything in between. So let's get started somewhere with all of this. So let's go with, it doesn't matter if someone's trying to get a £1,000 account and turn it into 10,000, or someone's on a 10,000 account and they want to get it to 30 or 40,000, let's say, or 50,000, whatever. There are some, let's assume that the trader has reached a given level of competency. They can make money.
Yeah. Okay.
So, how can they stay the course for getting that £1,000 up? And what things can they do to help them with that? So they're already relatively competent. They're making money from trading, much like the person with a £10,000 account. So the one thing that I've said or suggested is you're making some money. You're making some money from your trading. Great. But how can you compound that? Well, you can add to your account as well. And a lot of people will say, especially with people who haven't got a lot of money in a trading account, I don't have any surplus funds. So the first thing that I got going in my head is, well, could you take on a second job? Because if you really want to get your account into a more meaningful balance, whatever that balance may be, well, surely you would do everything in your power to get there. Whether you're washing dishes at the local restaurant, for a few hours a week, or you've got a side online hustle, whatever it might be, is it sure? And if that enables you to add a small amount of capital to that account, is that not worth it for a while? I'm just putting it out there. Not everyone's going to want to do it, but I think that if you really are desperate to succeed, then those are the sort of things that can really help. You've already got competent. How can we add more capital? So you're making X percent, let's say in a year. If you can be adding every month to that capital, that's going to make a massive compounding difference to your returns.
It's huge, and also it makes it more real because you're reinvesting into yourself every month. So rather than the £1,000 that you've had lying around for a couple of years, you're saying, no, I'm adding to my commitment. And I think that can actually benefit the way you trade, because every time you put more money in, especially if you had to go and get a second job to do it, you're reaffirming the need to look after that money. So using good risk management. So I think it's a really good one. And also, in relative terms, especially if you're the person starting with 1,000, if you're able to put a couple of hundred in, that's a big increase in relative percent each month. Then it can offset against the losses. Obviously, if you've got 50,000, that same 200 is still doable. I'm not saying don't do it, but obviously in percentage terms, it has a different effect. But I think what you're saying is hugely important. If you want it bad enough, you'll do it. And I find it interesting that a lot of these people that struggle to have any money to trade with, I've got the money to pay for the challenge. Yeah. They seem to be able to find the money to pay for a prop firm challenge, but I've not got any money to trade with.
Yeah.
Interesting.
Yeah.
So I think...
Yeah, exactly. Yeah.
I'm generalising a little bit, but...
Of course.
But there's that...
It could just be down to, I don't know, clothes. They got the nice clothes. Yeah, okay, you got the nice... Maybe you don't need to go shopping quite as often, or whatever,
Yeah.
So have a look at your lifestyle
Yeah.
and say, okay, well, can I be more frugal in certain areas? If I want to develop this trading account, but I don't want to have to, work extra hours doing whatever, then how can I look at my entire lifestyle and make some savings there so I can then do that? If you really want to do that and compound it, there's nothing wrong with just trading your account and building it up over time. We're talking about accelerating an account for someone who is profitable. So that's certainly
There's a nice crossover with delayed gratification. You're saying I'm not gonna buy the Gucci handbag, Gucci watch, whatever it is. I'm gonna put off a bit of short-term pain, but that crosses over to your trading, because you've got to have that element of delayed gratification with your trading. You've got to be in it for the long term. So I think my one that we've discussed before, and it's certainly something I'm really adamant about, is the idea of being wary of the target. So I want to turn the 10 into 50 or the 1 into 10 or whatever it is. Because if you are consistent, what can hinder that consistency is when you start creeping ever closer to this arbitrary target that you want to achieve, but the market necessarily isn't offering the opportunities right at that point. So the risk there is potentially over leveraging, or feeling that you've only achieved your goal if you hit the 10,000 mark. Whereas actually, if you over a period of years have turned 1,000 into 9,910, you've done extremely well. So I think I'm always wary of these fixed arbitrary targets, especially in a certain period of time, because even if that's based on previous historical data from your trading, it doesn't necessarily mean that's going to go forward. So you can risk seeing yourself as being unsuccessful when actually all it is the market is just not offering you the opportunities right at that point. So there's nothing wrong with having that, I call it a benchmark, but rather than this solid fixed target, because it can impact what you do.
I think having a goal is fine, and writing that into your overall trading plan, where you'll have a 5-year goal, you might have a 10-year goal, or within your plan. And I was only talking about this to some traders just this past week. So write that down and then chuck it in the bin. So the process of writing, as we know, when your goal setting is a good thing, but just chuck it in the bottom of the drawer and try and forget about that goal. Because if your focus is on the goal of 10,000 or 50,000, whatever it is, then how are you focusing on the process of trading? So what we got to do is, you might have that and then you've got to try and forget about it and get on with the business of executing and being the best trader you can be. Because if all you're thinking about is that end result, then that's going to become a problem. One thing, coming back to the compounding side of things as well, it's a bit of online compounding calculators. Really useful just to put in what your balance is and how much per year you might be looking to, you think you can achieve from trading, but then topping up as well. And you add that top up and it really shows you the difference, quite significant. So, and I think that milestones are an issue, is what you're referring to as well. Let's take that example of, you get up to 9,950. I'm nearly at that 10,000. And then all sorts of things can happen. The attachment issue to that benchmark level is high. And so, again, you take your eye off the ball as you get closer. The thing that got you to 9,950 is no longer there because you're looking at the money. So you need to be able to just carry on trading the same, but people don't. And then they get to that level and they start trading differently. They tighten up. They get fearful because they've made a load of money, and then fear creeps in because they don't want to give it back. I've got to that level. It's taken me all this time to get to this level, and now I've achieved it. They then don't want to give it back. So then what do? They tighten their stops up too much. They start banking their profits a bit earlier. All these little things. And the very thing that they did to get them to that point in the first place, they've stopped doing. And then what happens is they get the very thing that they're trying to avoid, which is a drawdown.
And I think it's important to reference it. This can be a percentage target. It isn't always just money. I've seen this with traders. They want that, right? I want to make a 10% return. They want you to hear all the time, like 10% in a month. Yeah. And and they get, it's amazing the amount of horror stories when they do have a good month and they get to 8%, or they start that focus becomes all they think about, and they, like you said, forget everything that got them to that place. I think that's a really important element too.
And I think that in the main, though, coming back to this whole subject of trying to turn a small account into a larger account, we know there's a lot of other sources where people can try and do that, and they want to go down these other routes, which is promising the Holy Grail. There is no Holy Grail, and if it was, everyone would be trading £500,000 accounts that they've been funded from someone else. Trade your own money. It's always the best way, and find a way to compound your own money. There's nothing better than trading that way than being at the mercy of someone else who might have a vested interest in you actually losing at some point, and then you end up thinking, oh, I've just done that for all this period of time and I've got nowhere, when you could have been doing it elsewhere.
Good. Great advice. So next question. Well, this question, it's quite a broad question. They said, when is a good time to trade more? So my response back, if I was speaking to this person directly, is what do you define as more? Do you mean, I think what the underlying tone of this is more, when is a good time to add more strategies, more markets? It's essentially something I see a lot, which is traders want to, if they start getting a little bit of consistency, they want to add to it. They want to trade more markets, trade more strategies. Or in some cases, I even see people that are looking to do more before they've even shown any kind of consistency in one particular strategy or one particular discipline. So to me, when is a good time? Well, I would say both of us come from a similar idea that often, actually what you should be asking is, when is a good time to do less? Because there is this constant tendency for traders to want to do more, but actually sometimes less is more. And actually not necessarily adding more strategies, more complexity, more markets to what you do is going to result in more profits. Traders often think quite linear and go, well, if this strategy makes me 30% a year, if I add another strategy in that makes the same, I'm going to make 60% a year. But are you able to trade both of those strategies effectively? We talked about this previously. Strategy one might be counter trend, which you are very good at, it suits you and the numbers work. Whereas the other strategy is more with the trend based and it doesn't suit you. So it isn't as simple as just saying when is a good time. It's more about understanding you as a trader, what your strengths and weaknesses are, what you're able to do well, and actually maybe the focus should be doing more of what you're actually already doing in a way. And for some traders, we've talked about this a lot, is reducing the number of markets, not actually adding more markets in. It isn't a guarantee that just because you're good at one thing, adding more in is going to help.
Well, no, and sometimes people underestimate the mental capacity that's required to be in multiple positions. So people think, oh, I'm doing all right being in, a couple of positions, made, let's say, at a time, one or two trades, open trades at a time. Yeah, if I'm in, like you just said, if I'm in 3 or 4, then I'll be taking twice as much. And it's, in theory, yes, but you're underestimating what's happening up there because you're now having to manage more. You've got a life, you've got probably a job, you've got a family, all these other things going on, all these positions. So you're more prone to making trading errors and making decisions on those positions because you're managing too much. That's when people are more likely to think, oh, just move the stop up on this one because I've got all this exposure, I'm just going to move up this one. And then you mess up that trade that gets stopped out only for it to go higher because you were basically managing too much and you realize, so all that can happen. Coming back to the whole less is more philosophy, I was just talking to a trader just yesterday and she was saying that very thing, that one thing that's changed, she's been trading for like 16 years now, but she was saying the one thing that's changed certainly over the last 5 to 10 years is rather than trying to trade more, like you've just said, look at what you are trading with and see if there's a way to get more from the thing that you're already good at. And so you don't necessarily need to add more of these other things. It might be, so let me give you an example. So she said, for example, she's really comfortable trading literally a few markets. And she's got her approach, she's got a method and all of that. And so as an example of making more from what you're already doing, she will add, that's what I do and you do, add to her winning trades. So get in here, and then we'll add to the winning trades. And when they come through, you get massively compounded return, so to speak. And she said, and actually, at times when it's all aligned and it's all running quite well, she's just banked, let's say, a 3-hour profit from her previous trade. She'll use that profit. So rather than going in with a new trade with 1 hour risk, she'll actually say, well, I'm going to put the 3-hour risk in. It's a profit from the... So yes, it's sacrificing potentially the prior profit, but it's a way of, again, getting that extra traction from what she's already doing. She's not having to do more. She's just doing more with what she's doing. She's trading what she is trading at a higher intensity.
And she's built up the resilience to be able to do that because she's got the experience and time in the market, but also she knows what she's doing inside out.
Yeah.
So, somebody listening to this would go, oh, okay, so what I should be doing is I should be risking all of my profits on my next trade.
Yeah, they won't be ready for it.
Exactly. Yeah. So you always say traders evolve over time, and it's the same. I always call stage 4 personalization. So it's when you've realized what your strengths and weaknesses are, what you're good at, and that's when you can personalize things. And that, for a lot of traders over time, is not doing more, but actually doing less and doing more with what they're already doing.
Yeah, I have to backtrack on what I said there because you just highlighted it. Even adding to trades, even if it's the same amount, and even after you've moved your stops up and you add a new one, that's not something you can. Every trader can just go straight out and do. That takes time. Emotionally, it takes time because most traders get into a trade. If it goes into profit, they move the stop up. Risk-free trade. I can't lose now on this trade. Adding in is, well, okay, you may have moved your stop up on the original position. Now you're putting a new position in. It's not comfortable. You're in you're coming out of your comfort zone.
Exactly.
And so for a lot of traders, that takes time to learn that, to be able to embrace that, because that's not somewhere where most traders want to be. They want to be in their comfort zone and stay in that lovely little comfort circle as soon as they can, get that stop up. So it's, again, like all aspects of trading, it takes work. What we're talking about here is you can do more, you can bring more strategies in, but this is just an alternative, is to say, well, what else can you do with what is right in front of you, which, let's make the assumption you're comfortable with what you do have. Well, is there a way of getting more from what you already have?
Love it. Yeah. Love it. So this is one of those where we get questions come in. This is more, I think it was more a comment that somebody made, and you picked up on this, and I think this is really good. So this, I'm going to call it the one-for-one illusion. Let's call it that. I think this is quite interesting.
Yeah. So again, this comes back down to, like with so many traders, wanting to be right more often. So the first thing is, this trader put a post up on one of my social media channels, and they're saying, look, do you know what, Charlie? I prefer having a 60% win rate, and I have a 1-to-1 risk reward. And for every 100 trades, I make 20%. And I'm reading that thinking, you haven't actually done 100 trades on it. I can tell by the language. Yeah. You've just done the maths and saying, oh yeah, this is what I would do. And I understand that. I understand, why someone is going to want to have a higher win rate and not be holding on for, 2R, 3R, whatever. But what was interesting in his post, in his question, was he said, it's much better for me this way, because if I miss a trade, then it's just a missed trade because it's only 1-to-1. As opposed to if I was looking for, like he said, he's seen some of his trades have become 7R and more if he'd have held on, depending on where he's going to come out. And he said, yeah, but if I missed out on that, then that's a big miss. But this is only, I understand the context of what he's saying. It's only a 1-to-1. However, let's just be crude and say, okay, 10 trades, and out of 10 trades, you're going to win on 6, lose on 4, on what he's saying. Mm-hmm. So you miss one trade, you've made no money out of those 10 trades, because you've missed one trade. So now you've only had 5 winners, and
that's right.
That is, yeah. So you've now not, and you've only got a 1-to-1 risk reward. So you're now not making any money anyway. So you become a slave to win rate.
Oh, I like that. Yes, it's the difference for me. It's the difference between logic and reality. It's the difference between, like you say, doing the numbers on a piece of paper and saying, well, look, logically it works.
Yeah.
And the amount of times I've been challenged on this, well, what you're saying this, Ali, but on paper, 1-for-1 works.
Yeah.
And I can be out of the trade quicker. And it, again, the trader is justifying, I think, being in their comfort zone. It's like moving your stop up quickly. It feels nice to be out of the trade because you can notch up a win on the, that's a winner, that's a winner, that's a winner. And traders want to feel good. And I always relate it back to, if the majority of traders are acting on their emotions and wanting to get short-term pleasure and avoid pain, well, of course they're going to want to do this. So I think it should be a case of, you almost should be forcing yourself to trade with a bigger risk to reward, not arbitrary going for 3-to-1s and 4-to-1s for the sake of it, but understanding that most traders don't want to do that. So being on the side of the trader that is willing to hold, because it is, even when you start out, holding for a 2-to-1, holding for a 3-to-1, it's tough because you're wanting that win. And I think it's very easy to justify how you are emotionally. So as the trader or somebody listening to this, ask yourself, am I wanting 1-for-1? Am I spouting logic? But actually the reason I want 1-for-1 is I'm fearful for holding my trades for longer. Because very often it's an emotional reason, but they're justifying it with logic.
Oh, he did admit that he wanted to get out. He did admit that at least as well. But said, I can't hold on. And so I found this way, but I don't think he's done enough trades yet. Because what will happen is further down the line, that very same trader will say, yeah, I've decided that I quite like 1-to-2 risk-reward ratios now. So, yeah, that didn't work, did it, in the end? And that's the same language that the self-talk that people use. And they're like, yeah, I've decided I'm ready for this now. So basically what you were doing, was too much on... It's not that you can't make money, as you quite rightly say, with a 1-to-1 risk-reward ratio or even inverted, but you then do become that slave to the win rate as well. And it, for a lot of people, that's a danger zone. And on that note,
the danger zone. I love that. Better way to finish.
And on that note, his name's Ali Crooks.
His name's Charlie Burton.
Trey, safety out there.